Hello and welcome to the Daily Finance Wrap, your daily dose of personal finance updates covering investments, insurance, loans, real estate, and everything else to do with your money. Of course, with expert analysis. We love to make the show interactive, so please feel free to write in with your questions and your queries, and we'd be more than happy to answer it. But first up, a quick check of the top headlines this Monday evening. It was another rough day on Dalal Street as the Nifty clocked in its longest losing streak since February 2023, down for the seventh straight day. IT and energy stocks led the losses in today's trading session. The Nifty ended below its 200-day moving average, which it had maintained and resisted over the last few weeks of trade. The Sensex was down 240 points, while the Nifty ended with a cut of 74 points. Investor sentiment was impacted by a weak close on Wall Street, followed on by concerns the US Federal Reserve will slow down its rate cutting cycle on back of inflationary measures undertaken by the Trump government. Higher than expected valuations, foreign outflows led to further losses on day trade. Well, it was a bad day for energy stocks. Analysts have downgraded shares of Indraprastha Gas and Mahanagar Gas Limited, the two major city gas distribution companies, once again. This follows the government's decision over the weekend to reduce AMP gas allocation to these companies by an additional 20%. Gas allocations have been reduced for the second time this month, or rather, the second time in the last 2 months. City gas distribution companies are now only getting 40 to 45% of their gas needs through the administered price mechanism, down from 65 to 70% only a month ago, versus back in 2021 when the allocation stood at 154%. This latest cut means companies will need to rely on a mix of sources for their gas supply. They will also have to use spot LNG, high pressure, high temperature gas, and gas from new fields, along with the reduced APM gas quota. As a result, the cost of raw materials for these companies will rise significantly, with 50% of their gas now needing to be purchased at market prices. Companies will now need to raise prices as well to manage the increase in raw material costs by 10%. Meanwhile, in other action, Mama Earth's parent company, Honasa Consumer Limited, shares fell sharply by 20% to trade below their listing price, following multiple downgrades after a disappointing second quarter earnings. Mama's stock fell 20% to hit the lower circuit at 297 rupees a piece on the exchanges. Mama's parent reported a loss of 18.6 crores against a profit of 29.4 crores a year ago. MK Global changed its rating from buy to sell and cut the target price to 300 all the way down from 600, suggesting a downside of 20% from the previous close. Citi has downgraded the stock to sell from buy and reduced its target price as well, amid growth challenges and slowing urban consumption. Well, on a more macro level, according to a report by Motilal Oswal Financial Services, the total number of Demat accounts in India have now reached 179 million as of October 2024. However, new account openings have actually slowed, with a 3.5 million accounts being added in October, down from a year-to-date monthly average of 3.9 million. During this period, CDSL continued to lead in market share growth, both in total and new Demat accounts, while the NSDL's market share has dropped by 400 basis points year-on-year in total accounts, and by 200 bips in new accounts. Meanwhile, the number of active clients on the National Stock Exchange have been rising steadily, with a 2.1% increase month on month, reaching 48.9 million in October 2024. Well, in news that affects us also in many ways, the Central Board of Direct Taxes has launched a compliance and awareness campaign to help taxpayers accurately report their foreign assets and income from foreign sources for the assessment year 2024-25. This campaign is to ensure that correct completion of scheduled foreign assets and the accurate reporting of income tax from foreign sources for those who've already filed their income tax returns for 2024-25. The Ministry of Finance highlighted that compliance with Schedule FA and FSI is mandatory under the Black Money and Imposition of Act 2015. which requires full disclosure of overseas assets and income. As part of this initiative, the CBDT will send informative SMSs and email messages to resident taxpayers who have already filed their ITRs. These messages will be directed at individuals identified through bilateral and multilateral agreements, indicating that they may hold foreign accounts or assets or have received income from foreign sources. Well, those were the top headlines that we're tracking this Monday evening, but we're up for a very interesting conversation, and this one is money traps that you should avoid as a young investor. What we're calling it is 101 Beware of Bad Financial Advice. And to help us understand and take this discussion forward, we have with us Viral Bhatt, founder of Money Mantra. Viral, hi, thanks for talking to us. This is a rather interesting subject, right? Money traps, like we're calling it, almost like honey traps. But let's make a more broader conversation to set up the agenda as we go along the next 20 minutes. Why don't you start by telling me why is it risky to blindly follow someone else's financial advice? And how can individuals tailor advice to their own unique financial situations, objectives, and risk profile?
Sure. Thank you for having me on the show, first of all. Yeah, definitely. So, see, I would say that bad advice is very easy to get in today's world. Looking at the social media and so many things going on in the market, and this kind of any bad advice, or you can say or not a true advice, is very much uh, uh, common right now in the world, right? So, but yes, definitely, it is very risky to follow such kind of advice blindly, because there are certain things any individual should keep in mind before uh, trusting those advice, or relying those advice in their personal financial life. So why it's a risky? First of all, people might have a different financial goals. Uh, People might have a very financial risk tolerance. Uh, People income and expenses are different from one or to another people, right? Then uh, see, many a times people, uh, we always tell, as a financial intermediaries and advisor, we always tell to have a patience in the market, right? And uh, too many noises are not good for their financial health. So considering that there are a different risk associated with all the financial products and all, and so maybe market timing should not focus on more on the market timing, but having disciplined time, spending time in the market is most important part, and we
Right.
always tell that to our clients, right? So yes, these are the risk factors should people consider before trusting any particular advice or doing any kind of investments in the financial markets.
You're right, Viral. I think what a lot of people forget that with this new age DIY investing in so many platforms, or offering unsolicited advice, one should understand that this is not one size that fits all. So it cannot be
Right,
a cookie cutter approach for everybody, right? You may have the know-how, you may not have the know-how. You may have
right.
the you may not have the time, and those are very important distinctions one needs to make. But let's compare this to medicine, because I think the best way to put this down is when I talk about a financial advisor, I compare it to being the munim of the family, because they should
Right,
know everything and they should be the closest you have to keep an ally. But you compare it to doctors, and you want to tell me
right.
why you compare this to doctors or medical treatment? Because I do understand that, like we said, customization is key, and the minute people understand and young people understand it, I think half the battle is won.
Yeah, absolutely right. So, uh, to be very frank with you, many a times my few clients uh, always tell me that you are a financial doctor, right? And you are a financial doctor of mine. But why they are saying such kind of things to me, that see, there is a definitely a parallel between medical treatment and this financial personal finance advising and all. So let's say if you go to any doctor, what doctor do first is the diagnosis, right? So in medicine, doctor do a diagnosis, understand the patient symptoms and medical history and all, health status and all. And in financial planning also, we try to assess the income flow, the expenses part, the liabilities part, the financial goals part. So in financial planning world also, diagnosis come first. Then as you mentioned that no one size fits for all the things, right? So here also, in medicine also, in medical world also, each patient's body, genetics and lifestyles are unique, right? And in financial planning also, each individual has a different financial goals, risk tolerance and time horizons. So no one size fits for all the solution. uh, in medicine, in medical world, we always say, or doctor always say that monitoring and doing those adjustments with your body, with your lifestyle is important. So regular checkups are important in medicine. Similarly, here also in financial plannings, there are different life events comes, right? So according to that, we have to adopt the things in our financial lives and take the action according to that. Then so see, many a times we have also heard that in medical world, doing the uh, uh, self self medicating or following generic advice from non expert is very dangerous. In financial planning also, copying another's financial advice, trusting on the friend's portfolio, trusting on the financial agent or advice or insurance agent's advice is very harmful, right? So risk of self treatment is also dangerous in medicine world and similar to in financial planning world. And at the end, I would say that definitely expert guidance matters, right? Qualified doctors, we try to hire, go to professionals doctors and having a good uh, uh, you can say a good expertise or good experience. Similarly, a financial advisor also can navigate your financial problems and give you the structured and disciplined advice to your personal finance matters.
Right. Well, I completely agree with you, right? It's not one size fits all, and you want to customize everything to your needs and your objectives. And what works for you doesn't necessarily have to work for your neighbor. And I
Right.
think if people give you advice and it's unsolicited, they only tell you about the hits. They very rarely tell you about all the wrong
Miss.
decisions that they've done, right? And I guess that's why people like you are in business. But let's break this down. And I hear this so often, right? Anything that comes in with a risk free tag, in my opinion, is something one should be wary of. Low risk, yes, I understand. Risk free, I'm not sure. What are your thoughts on that? Because even money in a savings account carries some risk at the end of the day.
Absolutely right. So there are two things I wanted to highlight here is that this statement can be true only in a perfect world. However, as long as we live in an uncertain world, this cannot be hold true for sure. Yes, there is a certain investment avenue that possesses very little risk, such kind of such options like fixed deposits or a savings account or government securities. But it's a pertinent to note that even these instruments come with a risk of a change of government regulations, interest rate risk, or economic conditions. So yes, risk-free investments is not hold true. Limited risk, minimum risk definitely can be hold true.
Hmm. So let's talk about low risk instruments now, just for the sake of understanding and for our viewers' knowledge of what we mean when we say low risk, medium risk, high risk. Now, our fixed deposits, an example of low risk, we can do a quick rapid fire, which could be helpful. Are fixed deposits low risk, in your opinion?
Absolutely low risk.
Savings account, low risk?
So low risk, absolutely.
Okay, let's make this a little tougher. Government bonds, Government of India
Uh,
bonds.
You can say, you cannot say a low risk. It's a kind of what you can say, uh, upper than the lower risk, you can
So
say.
we call it
uh,
low to medium risk.
Low to
Uh,
medium risk, yeah,
Low
right.
to medium. AAA corporate paper.
Triple A corporate letters, low to medium risk.
Okay. What? Let's make it a little more complicated. Double risk, double A, where there is a little bit of credit risk involved. Medium
Medium to
risk.
high risk. Medium
Okay.
to high risk, yeah.
Okay. That, of course, is on the debt side. So anything beyond double A, I think, does carry a credit risk, which viewers should be
Absolutely,
aware of. And
absolutely.
I think the usual advice is if you're investing in debt, you want to avoid taking credit risk because you're already taking duration risk. And the risk part should be left to equities. So let's talk about equities. And I want to break this down product category. Mutual
Sure.
funds, equity mutual funds in terms of risk diagnosis.
Medium to high risk.
Direct equity, stocks only,
High risk. High risk.
futures and options,
High risk.
high risk. Okay, so this is very helpful because this tells the viewers what one should avoid and what one should not avoid. So
Sure.
managed equity in the form of mutual funds is medium risk, but if you're buying stocks on your own advice or your friend's advice or your neighbor's advice, it's far more risky than investing it through a qualified fund manager in that sense. Let's talk about another very interesting topic, and that's credit card use.
Sure.
It is so important to optimally use your credit card. It's almost like a weapon, if used correctly, can benefit you significantly. But if used wrongly, it can actually be very damaging, not just today, but for the long term by impacting your credit score. So, you want to tell our viewers what are the credit card pitfalls one must avoid?
So, see, to be very frank, I wanted to point it out here is that if you use credit card prudently, it's a very good thing to have, no doubt about it. But looking at right now, we are into the zone where people are using credit card very much blindly. And four things I wanted to point it out here is that whenever you are using a credit card, if you don't want to falling into the debt trap, uh, please keep focus on these four things. First, pay the full balance on time, no minimum due payment. Please pay the full balance on time, spend only what you can afford, leverage rewards and benefits, and keep credit utilization low as possible as you can.
Right. That's, of course, to do with credit card. Another very important question to ask is debt management, Viral. And I hear people often confused whether they should take on debt, whether they should not take on debt. For example, you may want to buy a house, and God may be kind, you may be lucky, you may have been very intelligent and built a significant corpus, so where you could actually upfront a payment. Maybe a car
Right.
is a little far-fetched, but you could buy a house is a little far-fetched, but maybe you can buy a car which is through an upfront payment. Which in which situations should one take on debt, and in which situation should one avoid taking on debt? And this is critical because it's the constant debate between furnishing interest and an outstanding loan versus generating wealth by investing that money, which would have otherwise gone into a bullet payment in so many
Right.
ways.
Right, right. So see, debt is always a crucial thing as far as financial planning is concerned, and plays a very crucial role. But people are many a times falls into the debt trap. So there is a concept called a good loan and bad loan. I always say to my clients. And as far as good loan, home loans are a good loan. If you are a taking a loan for education of your kids, then it's a good loan. If you are starting your or expanding your business, then it's a good loan. So these three things are definitely a good loan. And in that, for me, the priority is, or first number is, purchasing a home on a loan is a very good thing, and it's a very good loan to have in your financial life. And what you mentioned about the car thing, in my experience, car loan is a bad loan, because if you are taking a car on a loan, then that particular car will be the depreciable asset. And home, why it is a good loan? Because it's straight away it is giving you a two kind of benefits. First is the appreciable assets, whatever the appreciation, definitely it's appreciable assets. And second, you will get a tax benefit on the same. So definitely please focus on the good loan and bad loan part. And as far as good loan, purchasing a home, starting your business or expanding your business, or taking a loan on the education thing for your children's, for your kids, then it will be a good loan for sure.
Okay, you want to give us some more examples of debt that reduces tax liability and aligns with one's financial goals? You'd
So
already
see,
mentioned to me about,
yeah.
college loans or university loans or education loans, but beyond that,
Yeah, so see, home loan is a most important loan, and it falls into the good loan part, where you will get a different type of tax benefits. You will get, if you are taking a example. Let's take a example of a 1 crore home, and in on that you are taking a loan for a 70 lakhs, right? So that on that 70 lakhs, a principal amount and plus the interest amount which you are going to pay, right? On the both the things you will get a tax benefits, right? And on a second home also you will get a minimum kind of a benefits on the same. So yes, taking a loan on the home kind of a thing will definitely give you a good tax benefits. And apart from that, that property will also appreciate in the near future, right? So yes, home loan or home, taking a loan on the home side, definitely you will not get a tax benefit on the land, but yes, home loans, residential, definitely you will get a tax benefit.
Viral, one other area that I want to touch upon, which is what we see a lot of youngsters not do, right? And it comes from a place of living life on the edge in so many ways. Most of them do not have an emergency fund or a corpus in so many ways. How important is that, and how important is this mistake that one must avoid it, because it could lead to a lot more if you're unplanned in so many ways, right?
You can say that the first base of the financial planning is having the contingency in place for yourself, right? And in the COVID era, we already observed that very well, that if people don't have the contingency or emergency in place, they will suffer like anything, right? So first of all, whenever before investing, I would rather urge people to having the minimum corpus for their emergencies, maybe for 3 to 6 months of your income, or maybe 3 to 6 months of your expenses, right? So you should have a emergencies in place, because see, you never know that emergency uh, whenever fall into your financial world, right? So you should have an emergency, and for that emergency, not only by saying that yes, I'm having that emergency fund in my bank account. Actually, I always urge to people that you should have a emergency investment, emergency corpus investment, dedicated emergency corpus investment for yourself, maybe into the recurring deposits, or maybe into the debt funds, maybe a short-term duration fund or a medium-term duration funds. But you should have a emergency in place, emergency contingency fund in place in your financial planning.
Right. How important, in your opinion, is it for young investors as well to diversify their portfolio? And the reason I ask you this is because post the pandemic, so many young investors have come into the market and made potloads of money. They've never seen a down market. I mean, this is the very first time that they're even going through a little bit of a correction, and most people are getting very nervous. I'll tell you that. How important is it for these young investors who've made a lot of money to remember that diversification is key, and diversification not across stocks or products, but across asset classes?
As whenever a diversification topic occurs, I always say that if you see your hands, all the four fingers and thumb are not in a size, a different size, right? And that's the way the diversification works, right? Diversification is most important part in your investments, because we always say that one should not put all eggs into one basket, right? We should have a direct equity also, we should have a mutual fund also, we should have a gold and silver also, we should have a real estate also, we should have a fixed deposits also, right? Broadly, equity, debt, and commodities we should have in our portfolio, because uh, in a certain world, in a certain markets, or in a certain economy, all the asset class will not go on a upper side. Someone will rise, someone will downfall, right? So whenever equity not perform, definitely debt will be performed, or commodities will perform, right? If market will not, if market will give a good returns, then many a times debt will not good give returns, or commodities will not give returns. So diversification will definitely minimize your risk, right? It will better your returns overall in your overall portfolio. And you should have a proper time allocation to each and every asset class. Whenever you diversify your portfolio, you should check in to your portfolio once in a year and see how that particular asset class performs with other particular asset class.
Another one, and I'm going to bring this up because of all that excitement around Bitcoin recently. All these trending investments. Now, that's the new thing, right? Anything with a hype, and you think you're going to be the next big billionaire by investing in a Bitcoin, for example. How important is this for young investors to take all this with a pinch of salt? Because while it all looks rosy, the fact remains it's not as easy to make harder. It's not easy to make money.
See, whenever you talk about money, you should know that there is no shortcuts as such,
There
right?
is no.
Maybe, yeah, there is no free lunch. You are rightly said. So, so no free lunch. So definitely, you should be more disciplined towards your money. You should have a more consistency whenever you are investing in any particular investment product, and where the underlying. So, if we don't understand that financial product, right, we should not invest, right? There has to be some kind of a proper logic and reasoning while doing any particular investments, right? There has to some kind of a theory to it, right? Fundamentals to it, right? Whenever you are investing, you should check in everything, all those things, and you should do your investment. And as far as cryptocurrency or bitcoins or any this kind of a things, it's first of all, it is not regulated at all, right? Where there is a no regulation, no backing at such, right? Governments many a times also beware to the investors that don't fall into the trap kind of such kind of a things, right? We should invest in a well regulated and past performance with the proper fundamentals. We should also always focus on a such kind of a things rather than finding any kind of a free lunch or a shortcuts.
Right. Very lastly, Viral, to just wrap up this conversation, what are the key red flags one should be able to identify or be aware of when purchasing or investing in a new financial product?
So see, as far as focusing on the new financial products, definitely there has to be some kind of a regulatory behind any particular financial product, right? A transparency, right? The past performance of that particular product, and who's managing that particular product, right? Where in which instrument they are investing, right? Let's say the example is mutual fund. Which mutual fund? Large cap mutual fund, mid cap mutual fund, or small cap mutual fund? Which kind of a sectors they are investing into that, right? Which kind of a allocation they are going to have in those kind of a stocks, right? So you should have a proper you should yourself go into that particular product, have the conversion, be any particular hand holding with you, any financial advisor, financial profession with you, and ask the questions. How? most important, ask the questions to your financial advisors, right? It is very difficult to ask the question on the platform, right? Any particular DIY platform, it is very difficult. But if you have any in-person conversation with your financial advisor or any person, then that will be a very good for you.
Right. Well, let's take up a few questions that we've got coming in. We'll try and keep it quick and snappy. But Sharmi Patel writes, and she says, can you please share some examples of what is a too good to be true scam?
So see, right now, if you observe, when any particular country do it kind of a growth in their digital world or digital space, such kind of financial frauds keep coming every now and then. So I always suggest, or I always recommend it, don't uh, don't click any particular SMS links or WhatsApp links. Don't enter into any particular WhatsApp group where you don't know what's exactly going on, and beware with the high returns kind of a, what you can say, uh, demanding kind of a, you will get a 20% return or 30% return or 50, your money will be doubled in a some time. Such kind of words or statements, it's not true. And whenever you are get into any particular financial investment contract or relationship, you should have a proper understanding, proper knowledge, and trustworthiness on that part. Then only you should enter into such kind of a things.
No, you're right. I think read the fine print, and more important, if you don't understand it, don't invest in it. Keep it
Absolutely.
as simple as you can, right? Because the whole idea is the simpler you keep it, the easier it's going to be. And more importantly, please focus on the fine print. Nobody tells you the risk or the lock ins these investments come with. And those are most important. And watch out for asterisks, because I think those are always things that you want to keep an eye for. And also the smaller
That
writing.
star mark,
Yeah.
that below the
Print is
right.
most important. Well, we have one more question. This comes from Preetham Das, and Preetham says he's been investing in mutual funds from the start of this year. The last few weeks have been difficult. Yes, Preetham, they've been very difficult. The Nifty is down 10%, but the fact remains some of the portfolios have not done as badly if you were well diversified from a broader asset and market cap wise. His advisor, the good thing is he does have an advisor. His advisor tells him, do nothing and stay put. Viral, do you concur?
100%, 100%.
Maybe buy some more.
So see, as far as whenever you are investing in equity market, it's a long-term game, right? You have to define your long-term very well. Whenever you are into investing into equities, 1 year, 2 year, 3 years is just years, right? You should have a proper more than 5 years, 7 years kind of investment horizon. Be disciplined. Whenever markets go negative or corrects, like current situation, try to add more, try to add as many as invest money you can invest into such kind of a markets, because it will definitely give you an edge or power of compounding or a good returns after a 5 7 years for sure.
Right, Shami. There's one last question, Viral, and this comes in from Kunal. Exactly what I was referring to. And Kunal says he follows a very simple rule where he buys more when the markets fall. His
Okay.
SIP figure now is 15,000, used to be 10,000. Do you agree with that? Do you think that's the right way to approach your investments when the market starts falling?
Absolutely.
You should buy
Yeah.
more?
Yeah, absolutely. It's a rupee cost averaging kind of a formula where markets are down, you will get the more units as far as you are doing SIP into that. And whenever markets rise, your NAV will be rise and you will get overall returns will be good. But yes, time horizon should be 5 7 plus years. Then only you will get a rupee cost averaging benefit, power of compounding benefit into your investments.
And I think these are very important attributes, right, of a well diversified portfolio. I think the power of compounding, which we didn't get a chance to talk about, but I think that's another very important advice for young investors. You want to spend a minute on this, Viral, before we have to wrap up the show, because I think power of compounding is critical, and most young people don't understand the importance of it, and they keep going in and out of investments, in and out of funds, already carries a tax liability, and more importantly, then you lose out on the power of compounding.
Absolutely. So see, if you don't need money in between, don't see the markets and react yourself, right? Because as we say that power of compounding is a eighth wonder of the world, right? Why we are saying that? Because there is a past performance and practical performance happened with the investors, right? We know that image of the Warren Buffett, where in a certain years he did not get any kind of a profits or returns. But once will be patient enough with your investments, your money will grow like two times, three times, five times, 10 times also, right? So have a patience with your investments is most important. And we know that story of the bamboo, right? Bamboo, when we do the seeding of that bamboo tree, initial years you will not get any kind of thing, but any at particular stage or in a particular year, it will grow zoom like a thing, and you will it's a practical example. And we know with the mangoes also, right? In a certain 5 years, 10 years, you will not get any kind of a thing, but after 5, 10 years, mango will bloom like anything, grow like anything, and you will get a good kind of a thing to eat.
You're right.
uh,
To sum this up, invest once you have a plan in place. Ad hoc investing never helps you achieve your objective. Invest for the long term, but that doesn't mean that you invest and forget about it. You need to review your portfolio and make portfolio changes where it's required. I think importantly, beyond that, is be mindful of tax implications, because you don't want to make money and give up more in terms of paying taxes. So, tax
True.
is another important avenue or aspect to be mindful of. And like we always say, it's time in the markets, not timing the markets, which I think is
Perfect.
also an important piece of advice. And if you are a DIY investor, please do your research before you go out and buy stocks. Don't buy on tips. Buy on back of what your advisor tells you and what research you've done, because tips may work when the markets are going up, but when times get tough, these stocks and these investments will become very hard and will eat into your hard earned money. But I guess, Viral, we've summed that up for our viewers. Thank you very much for joining us today.
Thank you. Thank you. My pleasure.
Viral, good evening. Bye.
Bye.